Hello and welcome to All Talk. Today we have here with us Nimesh Mehta, who is the Director and Country Head, Sales and Products, ASK Investment Managers. Hello, sir. Welcome to the show.
Yeah, thank you.
So I want to start by asking you that when we see Category 1 and 2 AIF, in that private equity funds and venture capital funds deliver returns up to 18 to 20%, whereas the equity funds, they deliver more than that as of now. So why do you think the investors should look at the unlisted space?
So we don't have any unlisted opportunity at ASK, but this debate always goes on between. Say it appears that it is MF or alternates or MF or PMS, which should not because and PMS. See if you in life as you evolve and grow. Let me give a very different example to you. A car, somebody living in the zoo, they may have a Santro or a i10 car, but they may for one particular requirement, and they may also have a SUV car or a Mercedes car for other requirement. So likewise, what is in the investments also, basically your requirements are different, your risk profile is different, your return expectation are different, and therefore one can choose each of this, whether it's cat 1, cat 2, cat 3, or even a PMS, because to meet different requirements. So and I think biggest mistake happens where from our industry, if we say that we are better than them, it is actually complementing each other. So always I say it is not or, it is and. Okay, for a specific requirement you use unlisted. For a more liquid requirement, you look more listed PMS or cat 3 app. That's how I look in terms of for your question.
So equity PMS and Category 3 AIF are similar to mutual funds. Then why do you think the investors should look at this space for their diversification?
Again, same thing. I think I answered earlier. It's not too different out here. See, one of the things I can talk about myself, that why did I, over a time, from a mutual fund investor, I become more PMS investor, and I'll give a reason for that. And it's my personal experience, so there cannot be generalization. But in the early 2000 years, when I used to invest in mutual funds, I found the CIOs kept changing jobs, and they started their own business or something like that. And I am a long-term investor. I am a investor who thinks like retirement. Can I invest for 10, 15, 20 years? So what I need is a person or a people who can continue to manage my money for 10, 15, 20 years, the same. Because it's a people industry, right? You're investing because of the CIO or because of the investment manager. In case of PMS, I found that there are promoters, there are owners who run their own PMSs. So my own PMS, I mean, I put my money in ASK PMS about 11 years back, got about 18.8, 18.9% return. The uh, important part is there, the same Bharat Shah or the who led the investment then continue to lead now and maybe in the future. What you require, and as an investor, I require the continuity. Continuity of philosophy, continuity of process, continuity of same line of thinking. And therefore, when I get that, again, I'm not saying that MF doesn't. There are institutions which do very well out there. But for me, that person who is responsible for managing, who manages different points in time, whether it's a bull market, bear market, same philosophy, same operation, works well. And I think I have benefited immensely. And I have graduated from MF. I still own MFs, but my percentage of MFs has slightly gone down compared to what it was maybe 10 years back or 15 years back. Incrementally, I believe that. And the second part I'll have to tell you is that we are looking at returns from a point of view when maybe last couple of years, uh, the sectorals, the MFs have done very well. So you are looking at a point of time when MFs have done brilliantly well because they mimic the index. I mean, their portfolio mimic the index. So index have done well, MFs have done well. And I'm saying that's a great platform. I'm not denying that. But since you're looking at this point in time, if you go 3 years back, there is a huge gap between both the platforms out there. Yeah. So I'm saying each one has its own space. I'm not trying to say one is better over the other. Let me repeat what I said. I believe that both are complementary. Everybody should have a mutual fund investing as in terms of some of the large cap or a portfolio do there, and PMS for a separate requirement. I believe on a longer term basis on a 10 year. So third data point, we have completed 23 years of track record ASK. No PMS in the country has a 23-year track record, and our PMS has delivered 3 to 3.5% alpha for 23 long years. Yeah, that's not an easy time, In the 23 years, the world has gone through ups and downs. We've gone through Lehman crisis. We've gone through UPA 2. We've gone through so many difficult period of time. But still 3.5% alpha is a very, very large alpha to continue there. So I think clients can choose, distributors can, MFDs can decide, depending on the client appetite and what expectation he has. But again, I want to repeat, it is mutual fund and PMS and not or PMS. Just keep that in mind. That's my requirement. Thanks.
What are some of the popular strategies in category 3 AIFs and PMS?
So again, I can't talk for the industry. In Cat 3, recently what we have done is that we've started a long short fund. ASK Health Solutions is a company very young, just formed about a year back. We have completed 6 months of track record. At this point in time, I think the number has been about 9%. So it delivered fixed income plus 1.5% return. So again, the same thing what I said earlier. It depends on what is the underlying expectation of the client, what kind of safety net he wants, what kind of tenor which he has, and what kind of risk profile he has. I think long short is one of the very popular categories in the Cat 3, and clients MFD can consider if they wish to do that. Yeah.
There are so many strategies in PMS and AIF. How does a wealth manager shortlist them for their clients?
So I, for long, have made this presentation, and some point in time in the future, if I get opportunity at Cafe Alt and Cafemutual, there are 6 P's one should really look at while selecting any manager, and they are people, philosophy, process, product, performance, and the last comes personalized servicing. So one has to go through, and it'll take me about 10-15 minutes to explain, but this is a very short interview. Each one has stitch. If your people, philosophy, product, process are right, the performance will always be right over a 5-year or 7-year or 10-year period out there. In a 1-year, 2-year, it may be different. But if one were to select objectively and put parameter that, what kind of people are there, they are promoter founders, what kind of philosophy is there, what kind of process underlying they follow, because process is very important. How are the companies following the process of selecting stocks? So all of that needs to be considered, objectively evaluate, and all the managers you put across there, and wherever you feel well, who are good on 6 P's, I think that's the way. And again, I'll speak to Prem, and at some point in time, I'll share with this presentation, which I've been doing for almost 15 years now, how to go about selecting a equity manager using the 6 P's. Yeah.
Because that's something, very difficult to do for an investor. So thank you so much for those insights. We learned that, it's about coexistence and not the competition. Yeah.
Yeah, complement each other, not competing each other. Yeah.
Thank you so much. Signing off for today's show.